Global performance of the aquaculture sector has been quite sluggish since the start of 2018 due to building up of overcapacity in the domestic market and stiff competition from overseas. The start of 2020 looked like the beginning of a new upcycle, but the sudden onset of the pandemic only intensified the downturn in the industry. Shrimp exporter Apex Frozen Foods has weathered the prolonged slump without much damage. We think investors should start accumulating the stock at current levels as both shrimp prices and volumes appear to be inching upwards, providing a strong indication that we're well into the early phase of an upcycle. In terms of profitability, FY23 could turn out to be a strong year for Apex due to available spare capacity and focus on high-margin, ready-to-cook products. Apex Foods sales volumes took a major hit in 2020 because of the pandemic. In fact, the sales volume for FY21 was the lowest in the last 4 years because of lockdowns, closure of shipping lines and ports, and weak demand from hotel, restaurant and catering sectors. However, things appear to have stabilized as of now as sales volumes in Q1 and Q2 of FY22 have been largely stable YOY despite logistic challenges arising amid supply chain disruptions. Management has indicated that the demand across the US and Europe is very robust and the company was unable to service some orders due to acute shortage of shipping vessels and containers. Average realization in H1 has improved significantly YOY on the back of improved product mix and better global prices of shrimp. The share of high-value, ready-to-eat products has increased to 20% from 15% last year. Availability of containers and ships remains a challenge, but the situation continues to ease with each passing quarter. In FY21, management was able to maintain its operating margins around 11% despite lower capacity utilization, additional cost overheads due to commencement of newly expanded capacity, and lower export incentives. Performance on the margins front was noteworthy considering the challenging operating environment. Surge in freight rates and spike in raw material input costs have put additional pressure on the margins for the first half of this fiscal, but the management is optimistic of maintaining its profitability. Apex Frozen Foods came up with an IPO in 2017 to expand its production capacity and reduce costs through backward integration. The new plant has a production capacity of 20,000 MTPA, which takes its total capacity to 30,000 MTPA. This includes 5,000 MTPA of ready-to-eat products. With the capex phase almost over for the company, it looks well positioned to capture the incremental market demand over the next few years. The shrimp industry has been one of the hardest hit by the pandemic and subsequent supply disruptions. Closures of bars and restaurants due to lockdown, increased prices of soya or fish meal along with surge in global container freight and shipping rates have resulted in weak sales and margins over the past few quarters. The issues surrounding the industry have been adequately priced in the stock as the shares of Apex Frozen Foods are down 65% from its 2017 peak. Recovery is clearly underway, waiting to accelerate over the next couple of quarters. The current valuations of around 15 times FY23 earnings are very reasonable from a long-term perspective, and the stock looks like a bargain buy at current levels as both margins as well as volumes could surprise positively next year with gradual reopening of the hospitality sector.